and maximum return, and each point in this efficient frontier represents some amount of risk and return, and we come out with a minimum risk and maximum return. uh, in all these circumstances, we also come out with a point of tangency, which is which will be derived through indifference curve, and that will give us out of all this portfolio, which is again the best one, or which is the minimum volatility and maximum return region or the circumstances. Then we have also Sharpe ratio. So those ratios, I hope you have studied. Sharpe, Reynolds, Jensen. You have studied earlier the risk.
Sir, only in brief, Sharp and Tenor ratio, not Jensen's alpha.
Okay. So if time permits, we will do it through R also. How to get those Sharpe, Jensen's Lintner models. Okay. So that is what we have done. Now, further moving forward in portfolio, we will also see in R how to build this efficient portfolio. We will go for say CAPM model, then we will go for market model, then we will go for Fama French model. Okay, these are all portfolio theories. We will see how to build up the base or the mother of all portfolio theories, mean variance approach. After that, only all these theories has been developed, Fama French, or you say market model, or CAPM model. Okay. Now, uh, I hope all of you have heard about this event study. We'll cover now today the event study. What do you mean by event study? Can anyone say? Anyone has came across this term,
Sir,
event study?
in event study, we take a date or an event, let's say, and see what the difference is before the
Yes.
event and after the event. We make a structural point.
Yeah. So before and after event, we see the impact of a particular event. What was before and what is after. Okay. Yes. Someone has raised hand. Rahul or so.
No, so I was telling the same thing that basically we take one particular event into consideration and we want to observe how was the market reacting before this particular event and how it has reacted after the event. So if there are any abnormal returns which is being generated in the market due to this particular event. So
Yes.
this is yes.
So the basic idea is to see whether this event has given abnormal return or not. If it is given abnormal return, then means high abnormal return, then it has impacted a lot. Then we come out with whether that impact is significant or not. So basically, this event study is widely used in finance. Nowadays, in marketing, HR also, this event is being used. We use this event through either market model or CAPM model, and Fama French model also. Event studies are being built up. Now, what is that market model? It is Ri equals to alpha plus beta Rm. What is this CAPM model? Ri equals to, you can say, Rf plus beta Rm minus Rf. Okay. So we take this risk premium. Now, when we are doing this, what we are getting? We are getting one beta. What does this beta mean, or how does this beta is useful? If I am getting beta for market, suppose say 0.20, what does it mean?
For a 1 unit movement in the for a 1 unit movement in the expected 1 unit movement in the rate of return, which is the difference between the two rates of return, your expected rate of return will increase by 0.2%, by 0.2%. Yeah.
Yes. So, am I having some internet issue? I think your voice is breaking.
No,
No,
sir,
sir,
you're
your connection is stable.
Yeah.
Not Sally.
Yes. So Oli was correct. What we are saying is, if market will move by 1%, our stock will move by 0.2%. So that is how we say there is a direct relationship between market and our stock if it is positive, or if that beta comes out with negative, then we say if market will go up, our stock will come down. So that is how we come out with this market model. Further, if we go, we adjust with risk-free rate of return, then we come out with it, the same thing. But how does risk premium is impacting to our stock return, that we measure. Now, applying these models, we will come out with something called expected return, then actual return, then we come out with the abnormal return. Okay. So we'll see how does it arises, or how we can do all these types of returns. We can do it through Excel, we can do it through R or Python. So event study in Excel is very comfortable, or very friendly. You can see now you can first identify what the event is. Okay, what is the event? So this event study, whatever we have discussed, is it reflects the impact of an immediate event on the asset prices. So event study can be short term, can be long term. Okay, short term, and it can be long term. What do you mean by short term? We measure plus minus 2 to plus minus 40. Normally, event study goes for plus minus 2 to plus minus 40. And in long term, our models are different. We go for buy and hold return. Then we go for Fama French models. So for long term, measuring the impact of a particular event in the long
Sir,
term.
I'm,
Yes.
I didn't understand. In short term, we go for plus minus. I'm not understanding what that means.
Yeah, I'm explaining that. So plus minus 2 means, suppose 20, sorry, that was not, yes, 23rd lockdown has started. Okay, first lockdown has started on 23rd March 2020. Okay. Now you are seeing before 2 days, that means minus 2 days. Before 2 days, what was the impact? And after 2 days, that is means plus 2. After 2 days, what is the impact? Now we are segregating the event before impact and after impact. Then we will come out with whether this event has impacted uh, something differently as it was before. So before the behavior was different and after the behavior was different. So this event has resulted the stock price behavior to change in next 2 days. That's why we call it as plus minus 2. If I want to measure 5 days impact, I'll say plus minus 5. I'll take before 5 days and after 5 days. So we can go for 10 days plus minus 10. You go for plus 10 and minus 10. Like that we can go for up to 40 days. That is what the event study gives us. So what we are getting over here is, whenever any event happened, suppose you think through, are you now concerned about lockdown? Are you remembering the lockdown? or are you getting disturbed with demonetization now?
No, sir.
So, are you getting disturbed with the Yes Bank now? Because those events that happened will react in the market for a short period of time. For a long period of time, if it is a specific event that may impact for a long period of time, that's why majorly we measure the impact of a particular event in short period of time. Clear? But for long period of time our models will be different. Again, we can also do intraday event analysis. So this is on daily basis. So intraday event analysis also you can measure. Suppose suddenly one margin rule has been implemented during market hour, or suddenly budget is coming. So budget impact you can see on daily basis, you can also see on intraday basis whenever this budget announcement is happening. So it is very interesting to measure any of the events impact. It has been developed with the stock prices, but nowadays many are applying it into all the fields, including marketing, HR. Suppose suppose one new MD has joined in any company. What is impacting with behavior of employees? What is impacting with its financial performance? What is impacting with its production levels, or its marketability of that product, or market share of that product? So that also is widely nowadays used, this event study. You are getting what is this plus minus 2 to plus minus 40? Are you getting?
Yes, sir.
So relatively we use or we measure the impact of a event in short period of time. Where we can apply in corporate announcements, macroeconomic changes, or public policy. You take example like now T+1 is coming. T+1 announcement, the rolling settlement will come. Now the day SEBI circular came is the day that market got informed that from January onwards we will come out with T+1 rolling settlement. Now the day this circular came, you can see the impact of that circular in the stock market. You can measure how stock market is getting reacted to the SEBI circular. So all the policy changes. Yes, Ali.
So just one question here. So like you
Yeah.
said, this is used to measure the impact of a certain event on the market, right?
Yeah.
But now the thing is, we cannot just look at it in an isolated manner. There is going to be so many events that are happening at once. So how do
Yes.
we isolate the impact of one event from the others?
Yes. So if you see on the Brexit date, our election day result was coming in India, right? So election in Indian public election result was coming. So whether you will consider that event as Brexit event or Indian election day result event, that is one lacuna with the event study. If frequent events are happening, suppose say today, suppose Prime Minister has announced that so partly lockdown will happen. Okay, partly lockdown will happen. Maybe from or night curfew. Night curfew will be there. Then after 2 days, partly lockdown has been implemented. Like maybe you are allowed to get the things by 1 o'clock. Then full lockdown has come. So if these three things you will observe, it came in very short duration, 2 days, 3 days difference. So which will be your event? That is one lacuna for event study. Whenever you are considering impact of full lockdown, you have to be silent about other events. When you are considering partly lockdown, you have to silent about other events. Okay. So you are correct. That see in market, so many events are coming frequently. How you can segregate them, or how you can measure the impact of those events? So you don't have any option. You can you have to if you are applying event study, you have to be silent about other events. Second solution to it is dummy variable. Have you heard about dummy variable regression?
Sir, I did
Yes,
hear
sir.
about it. I'm just not sure how we can apply it here.
Yes, I am saying. See, dummy variable regression. So you create dummy for frequent events. Suppose same now night curfew has started from this day. Suppose same uh, say 12th March. Suppose okay. So 12th March, before 12th March you give 000. After 12th March you give 111. Whatever number of data sets you have. Now partly lockdown is there. Now partly lockdown suppose has happened on 14th March. So from 14th March, this is partly lockdown. Before you give 000, after you give 111. Then you have full lockdown. Full lockdown came suppose on 23rd. You give 111 after that, before that you give 000. That means frequently three events you are creating three dummies, D1, D2, D3, or you can name it as night curfew, dummy for night curfew, dummy for partly lockdown, dummy for full lockdown. Now you can regress it with your stock price. You are getting early. So you can measure differently impact of all these. Yes, Rahul.
So could you please repeat that? I did not understand. We are marking the days
Yeah,
with 1 and 0. But
yeah.
sir, isolation still does not happen, no. If we are taking the immediate effects, say like, plus minus 2 days of the window, or if we are like, taking 14 days effect, which is a longer period that we are taking into consideration, if like, this particular event is still coinciding, so there will be a dummy where like, one particular row will have two ones, right? Which means that there will be a effect of this particular, of both the events on each other, because it will be taking value one on that particular day. So then isolation is still not happening even if we are creating dummy.
Uh, okay. One is event study. Sorry, dummy variable is applied to measure the long-term impact of an event. Now, when you are creating different dummies, suppose you are getting one over here, but you are also getting one over here. It may happen that this is impacted, or this is impacted, or this is impacted. But your coefficients will be different for each of these dummies, because your dummy starts from this 12th, another is starting event starting from 14th, another is from 23rd. Your coefficient will be different. That's why you can measure impact separately. So how much this partly lockdown has impacted, or how much this night curfew has impacted. Are you getting Rahul?
But sir, if it is a long period event, or like like if it is an event that is expected to have a very long impact, then that impact is going to be continuous, right? So in a
Yeah.
regression, so in a regression, this dummy will continuously be one only.
Yeah.
While at the same time, other events will also keep on happening. So other events will also have a one. So then how will I know? Like for example, take COVID. So so like on one end we had a lockdown, on another end we also had a factor for sentiments, for example. So lockdown was continuously on. So how do I know? Okay, suppose if the market had gone down by 20%, 10% was caused due to the lockdown, and 10% was due to the sentiment itself, or something like this.
Yeah. So again, dummy variable has also lacuna. whenever you are considering again whatever dummy or whatever event you are creating dummy, you are again silent about so many other dummies that has happened. Okay. But you are more concerned about these major events or major happenings that has come to the market. That is how it will work. Or else see, you can't determine all the factors that impacts the share price. There are n number of factors. You are able to see some of the macro or some of the other countries markets or some of the performance of that sector, or you are correct the human sentiment or the investors sentiment. That's how behavioral finance has been developed. One new branch of finance has been developed. So that is how your hoarding behavior and your judgmental behavior, investors hoarding behavior impacts a lot. That is how nowadays also you are seeing, despite of macroeconomic downs, market is going like anything. So there is no fundamentally a market is not following any macroeconomic now. So that is how whenever you are creating dummy, you are again silent about all other happenings. So one advantage here is for each of the happening you can create one dummy, but how many dummy you can create, that is also a big question. How many dummy you can create? How many dummy you can create?
So whatever number of events we are observing, we have to create one less dummy.
Yeah, one less dummy, and that is minus one. We say n minus one, n number of say events are there, we can create n minus one. But suppose you have created 10 dummies, you might have left out with 5 more events that has happened, either company specific events or country specific or global specific. So majorly you will come out with some amount of determinants, not full. So all the events determinants you may not come out with. Are you getting Ali?
I'm getting, sir, but then I'm still not understand. We are admitting that we can never factor in all the events. So then, how can we be sure about the results of any of our analysis?
Yeah, see, one thing is diagnostic test at all. Then second is you are whatever you have assumed, you are dummies running with assumptions. Whatever you have assumed, you have to believe on that. That is the whole thing. Then that's why you are creating dummy. It's not actual. You are creating one dummy series and you are regressing with the dependent variable.
Okay, sure, sir.
Okay. So even you see 13th March there was a circuit breaker, market wide circuit breaker. 23rd March there is a market wide circuit breaker. Okay, MWCB. So 13th March it is hitted, Indian market has hitted circuit. 23rd March in 10 days of time it is hitted with the market wide circuit breaker. Suppose I will measure plus minus 15 days impact. If I am taking plus 15 days, 13th March, it will cross 23rd March. If I will take minus 15 days, here minus 15, then for 23rd March plus minus 15, plus 15 will come like this, and minus 15 will go like it will cover ended, and again 13th March. Okay, so when you are considering 23rd March, you will be silent about 13th March. When you are considering 13th March, you will be silent about 23rd March. That is what event study gives us. Event study cannot measure impact of simultaneous events on stock price. It will measure a single event's impact on stock price. Clear? Single events impact on stock price. Are you getting?
Yes, sir.
Now, this event study was first applied by Dolly in 1933. He has done this impact of stock splits on stock price. So, whenever stock splits happens, how much it is impacting with the stock price. Then Thama, Fisher, Denson, Roll in 1969, they have applied again for stock splits. So, whenever stock splits happens, how it has been impacting to how it has been impacting to a particular stock price. Later on, what happens? Later on, it has been widely applicable on this dividend announcement and buyback of share and other other corporate announcements. What is the impact of all those corporate announcement? And again, the again any of the macroeconomic happenings, like whether it is country specific demonetization or it is international specific. If you come out with the impact of demonetization, you will suddenly see after 3-4 days so many papers will come applying the event study. Even if you now also see event study demonetization, you will find so many papers. Even lockdown event study, you will find so many papers. So whenever event happens, suddenly researchers do this event study and come out with how many days it is impacting. Now, how do we go for doing this event study? First is event definition. What is this event? We have to define, and why we are assuming that this can impact to stock price. That logic you have to give and define event definition. Now, define the event. Then second is selection criteria. What selection criteria will come out? What are the selection criteria will come out? First is we want the selection criteria of the event. Okay, we want to measure this event for +-2 or +-5 or +-7 or +-10 or what. Second selection we need to do is we want to apply with how many stocks. Okay, whether we want to see in a sector impact, if it is a banking announcement, banking merger or banking announcement, am I considering all the banks? If it is a stock, suppose a SEBI regulation, whether I am measuring impact on the all the listed companies or only the high market capitalization companies, that also I will decide. Okay. Then we come out with calculating normal and abnormal return. When we calculate normal and abnormal return, we have one series. Suppose we have, this is our SBI data, and we come out with Nifty data to represent market. So SBI return, Nifty return. Now, if I will regress this Nifty with SBI, then I will come out with one beta value. Suppose say 0.02 or 0.20. Then what I can do is I can regress within these two and I can get the expected return for the event window. Okay. Expected return of the event window. How I will get expected return of the event window? Now I need to decide two windows first. First two windows. If suppose event has happened here, okay, suppose say this is 13 March 2020. Now I'll say plus 5 minus 5. Now my event window is 5 days. 5 days event window means I am going from minus 5 to plus 5. Yes or no? So, am I audible to all of you?
Yes, sir.
Yeah. So I'm going for minus 5 to plus 5 to measure the impact of 13th March circuit breaker on my stock. Okay, it was a market wide circuit breaker. Now I have to decide, one is event window, another is estimation window. What is the requirement of estimation window? What is the requirement of estimation window?
Sir, it depends on the researcher now, like what is the kind of effects he wants to measure. So if it is short term, he can take 2 days windows. If it is long
No,
term,
that is event
so
window. That is event window. So this will be plus minus 2 to plus minus 40. That is event window.
okay.
So what is estimation window? Anyone? Okay. See, estimation window is applied before 250 days. That means from this minus 5 to 240, 250 days, minus 240. That means it will be 245th. From this, whenever this event window ends, prior to that, we take minus 240 or minus 250 to calculate the beta. That market model we apply here. Suppose Ri equals to alpha plus beta Rm. This beta will calculate over estimation window. Okay. So when we get the beta value in the estimation window, that is last 240 days beta, we expect that this beta will also continue in the next period. So we bring out with we come out with say beta value from the estimation window. Now we have one return of, suppose say SBI, return of Nifty. Now we can calculate it calculate expected return. This expected return ER equals to again alpha plus beta RM. Now we'll apply this expected return in the event window, that is plus minus 5. And what is alpha? Alpha is the stock return. Okay. What is beta? Beta is the beta from this 240 days that we got, or we can also take alpha from this. Alpha from here in the 240 days. Don't take this alpha. Now alpha from 240 days, beta from 240 days, but RM return on Nifty, RM you take from event window. Again I am repeating. You take alpha from estimation window, beta value from estimation window, RM from event window. Then you will come out with the expected return for that day. Okay. So for each day you will come out with expected return like that. Like previously the market has behaved on this way, or the beta value was this. So you are expecting in the event period also the expected return will be this. Now, if you are coming out with expected return, you have one actual return. This RS is your actual return. Now, you can calculate abnormal return or AR. What is abnormal return? How we get abnormal return? Actual return minus expected return. If actual return is high, then you will come out with abnormal return will be high. If actual return will be low, then abnormal return will become negative and low. Yes or no? Are you getting what I am saying? All of you are following me? Muskan? Ali? Cherry?
Yes, sir, following.
Okay.
Yes, I'm
So,
following you.
Yes, sir.
okay. We can do it through any of the softwares. Then you can realize, but we'll do it in practically. But just understand what are the procedures to go for. Okay. So estimation windows main objectives to give us alpha value and beta value. Okay. That will be used in the event window for the expected return. Once we get that expected return, then we compare with our actual return, then we come out with the abnormal return. So this is actual return and we'll come out with abnormal return. Once we get this abnormal return, simply also if you can plot, you will see whether this event is impacted or not impacted. Second, whenever you come out with this abnormal return, whether it is, you can also come out with cumulative abnormal return or CAR, then you can say whether it is say it is significantly impacted or not, that you can check its significance level by calculating the T star. Okay. Now abnormal and normal return will be calculated, then we'll see estimation procedure, then we come out with testing procedure whether this result has or this event has impacted significantly or not. Then we come out with we present the empirical result and interpret and do the conclusion of that work or that particular event's impact. Now event window, we have seen, we have discussed it. It can be plus minus 2 to plus minus 40. Then selection criteria, you decide which of the happening, what was the event and how you can decide that particular event has an impact on how many stocks uh, or which sector. Then we come out with normal and abnormal return. Then we do the t-test for that to come out with whether it is significantly impacted or not. Either we can use CAPM model or market model to come out with the event to calculate the normal and abnormal returns. Now, in the estimation procedure,
So could you just go back by one slide?
yeah.
Thank you, sir. Done, sir.
Okay. So in the estimation procedure, we decide 200 or 240 or 250 before the event period. So when we say event period, if this is the event and I am taking minus 10 to plus 10, now my estimation period will start from here, not from the event day. It will start when event window is getting over, or event period. We can say this is event period. So my estimation window will start when event window ends. So that will help me to apply the market model or CAPM model. Then you do testing of hypothesis whether that particular event has an impact or it has not an impact. So you do through significance level through t-test. Then we come out with the empirical result and interpret and do the conclusion. So so this is the event.
So, I'm so sorry. Could you show the last slide again? I was just reading it. Thank you, sir.
So if you come here in one case, suppose 99 921 days you are taking as estimation. So minimum 200, 240, 250 you can take. You can take a longer period, but this will be your estimation window. Then this will be your event window. Okay. Now you apply market model, get the abnormal return, then average abnormal return, then cumulative average abnormal return. When average abnormal return comes, suppose you are measuring impact of a particular event on 50 companies, Nifty 50. Now you have to calculate for each of these companies, you have to calculate the abnormal return, then you just average, you will come out with AAR, average abnormal return, and if you accumulate that, you will come out with CAAR. Okay. And you use that R or CAR to again represent whether that particular event has impacted
So
or
just a doubt.
yeah.
So
Yes.
out there, your estimation window, you have it before the event window. Don't you also want a healthy amount of time after the event window to study what has happened,
No, no.
or you just want to
See,
study in the event window?
in the event window. See,
All right.
before event, why that estimation window is, so whenever event was not there, how this is behaved, or what was the behavior when event was not there. Normally, in normal situation, how these prices are getting impacted by market. So then you apply that in the event window. So it will be before the estimation window will be before the event.
Okay, so what I was thinking would be happening is that we would take, let's say, assume a 2 month period of time, or let's say 400 day period of time, and then the first 200 days of trading we would call that before event, and the last 200 days would be after event, and then we would do a A/B testing on both of them using a dummy. I mean, I would assume that's what we're doing.
No, no. We are not doing after event 200 days. Before we are doing, after we are not doing. After only we'll take this whatever event window is, not beyond the event window.
Is there any reason for this, sir?
Reason is we want to take the event impact only on a short term basis. So if we are going for longer period, we can go for Pharma French model and this buy and hold return. But specifically when we are measuring the short term impact, we are not going after event 200, 400 days. Yeah. So we are going up to 40 days. But if you are going for Pharma French model, you can go for 2-3 years impact also. But that event should be that much powerful to impact 2-3 days. 2-3 years. Then only you can go for longer period of time. But before event, the estimation period, whatever you are considering, is to get the beta and alpha value whenever things are normal. That is what, and that you are applying in the event window.
Okay, sir.
Yeah.
Mildly convinced, yes.
Okay. Okay. Only you are getting. You are there only. Only is there or not?
So I guess he has some mic issue.
Okay. Okay. Then so suppose we consider Nifty 50 companies and Nifty index. Suppose in one of our study we have done impact of this market weight circuit breaker on the Nifty 50 companies. Okay. If you we have considered that 50 companies separately how much it is impacting, then we consider the average abnormal return, then we have presented how many days. You can see this in for one event you can see -5, plus 5 plus minus 10 plus minus 20 plus minus 30. You can do in different windows. If in 10 days if impact is still there, in 20 days how much, in 30 days how much, in 40 days how much it is impacting, you can do that. Now suppose so this is a negative news that has came. If that will come, then what will happen? The Reliance stock price will come down. Even CCD chairman has committed suicide. So when CCD chairman has committed suicide, the CCD share price will come down. Now event will impact negatively. You have a news or an event, then how it is impacting you want to measure. Then after that you choose the event window, then collect daily data of Reliance, and you decide the event window plus minus 15. Then choose the estimation window, collect at least 250 days trading data. That will start from say that will be before the event, or before the whenever this event window is getting over, from that to minus 250. Then you collect the market data or indices data to represent the market return for the same period, then estimate the alpha and beta. That is how we will measure. Then use that beta and
So could
alpha
you go
in the
back to
event
the
window.
previous slide? So in this, in step 3, that you have chosen the data from 4 November to 2016 and 3 November 2017, and when we got the news was 4 November 2017.
This is one wrong. Yeah. This estimation window will not start from 3. It will start from, just go back 15 days. It will start from so 4 days, then 15, around 16th October 2017. Okay, it will not start from this 3-1. It was type error.
So I think November, not October.
Yeah.
November, not October.
No, this was October.
Because we got the news on 4th November 2017.
Yeah, 4th November. But our estimation window will start from 16th October. Just 15 days our window is. Just go back 15 trading days from
After
this.
the event would be November or before the event? It
Before the
ends
event. Before the event.
before the event.
Estimation period is before the event. So before event 15 days you just deduct. That 15 days is your 15 trading days from the event day. Then you consider whatever is coming
Okay,
previously.
sir.
So if you plot it, this is your 4th, okay, 4th November, and this is your 15 days minus 15 and plus 15. Your estimation window will start from this date. So this is your estimation window. You take 240 days, 250 days from this window, this date. Okay.
Okay, sir, understood.
Okay. Now use that beta that you have generated from the estimation window and use it in the event window to get the expected return. Okay. Once you get the expected return, you apply for calculating the abnormal return. So for calculating abnormal return in plus and minus 15 days, then you come out with the what are the impact on that particular event. Now subtract normal return and expected return, you will come out with the abnormal return. Then you see whether that abnormal return is statistically zero in your event, whether it is -2 plus 2 or -15 plus 15. Then you can conclude that whether this is if it is not impacted, that means that event has zero impact, then you can say market is efficient. If that event is impacted and investors are able to earn abnormal return, then that market is not efficient. So the efficient market's objective is to give say to uh, to ensure that no investor can earn abnormal return. Investor can earn a return but not abnormal return is compared to other investors. Okay. So you can take the T statistics values for significance level from 2.67 from 1.67 to 2.67. If you are getting T stat is nothing but coefficient divided by standard error. So the standard error you will get by running the regression in the estimation window. You use that standard error here, and the coefficient over here is your abnormal return or cumulative abnormal return. So you can see the significance level for abnormal return, significance level for cumulative abnormal return. Okay. So clear procedure. Now we'll go back for doing our exercise through Excel. Suppose you are coming out with a -9 plus 9 event, and you got expected return alpha plus beta RM. This alpha beta value you got from estimation window. Then you come out with abnormal return. Your actual return will be here. Then abnormal return. Then you come out with cumulative abnormal return and ART test, then CAR T test. Okay. So which event you want to see impact? Impact of which event? Anyone? Impact of which event? This was on SBI merger on SBI share price, or just missed. Yeah, SBI merger and SBI share price. So on one day, first day it has gone up, but later on the AR and CAR has came down because of those NPA issues of other banks. So it has came down. Okay. So far, all of you are getting.
Yes, sir.
Okay. Now, which events impact you want to see? Yes, anyone?
So maybe we can do announcement of first lockdown.
Okay. So that was 13th, 23rd March, right?
23rd March, sir. But sir,
24th.
I think the announcement came on Thursday and it started on Sunday. Because sir, I remember
No, 23rd March was Monday. That announcement was that one day curfew. That Friday or Thursday was
Janta curfew.
Janta curfew, yes. Okay, so let us use the data. Just you can go to download your data. Suppose say you are going to download first indices data. You go to search for Nifty. You want that. So first you have decided your your event is 23rd March. Okay, 23rd March. So you can get at least 1 year before or 1 year plus data. So 23rd March 2020, you can get data from 1st Jan 2019. For this estimation window, we will then calculate how many days we can take. So first download data from Jan 2019 first. To you will not able to download more than 365 days, I hope, but still we'll try. So to say March, April 30, you can say, sorry, this is 2021, 2020. Yeah, 365 days data you will not able to do. So you can go for December 2019. So take this closing price and date and create in one file. So this is your Nifty data. Okay, first Jan to so lockdown impact. Then you go back and download extra data from 1st Jan 2020 to so you can take this two data.
So just a doubt. You for 2020, from when to when did you download?
2020 we have downloaded till November, but we'll use few of them. So from Jan, sorry, it came low. From Jan 2020 to you can take April, up to April also you can take. Okay, we got the market data. You can say this is our market data Nifty. Now you want stock price data. Which stock you want to measure impact on which stock? Anyone? Neil?
Reliance ही कर लेते हैं. Let's do it for Reliance.
Yeah, Reliance has given good. Then
Sir,
you go to
sir,
product.
just a moment, sir. What I downloaded, the book one, and has come as empty file, sir. I'm a little confused.
Why?
Not sure, sir. I'm trying to figure out what I did wrong.
You can share your screen if you want. You can share. I'll tell you where you are doing mistake. Okay, you can go to stockwise price volume. Link I'll share over here. Then you can suppose say you want last 365 24 months. Okay, last 24 months, still it will. Okay, symbol you need to give. Suppose say Reliance. So in the series, you select EQ. So you are getting the Reliance share price. Okay, you are getting from 24 months is not given. Yes, let us see from which date to which date we got. Okay, from 24 September 2019. So we have to again download one more file. Okay, let us take its closing price, then we will closing price. Then suppose okay. So 24 September. So first Jan 19 will download. Select time period. So first Jan, this is Reliance. So it is there up to December. Now we want from Jan.
So just a doubt.
Yeah.
From which head in the website did you download Reliance equity from? From historical archive?
Yeah. I'll just show you. Yeah. Just see. Go back to product, then equities. Once you go to equities, so indices we have gone earlier. Now you go to equities. Now under equities, you go for historical data. Under historical data, search security wise price volume archives. You go to here. So this is what we are here. In the series, select EQ, then enter your symbol, then you will get it.
Thank you, sir.
Welcome. So all of you got this two data, or should I send to all of you? Okay.
So it would be nice if you could send the data.
Yeah, I'm sending. Lockdown impact. Okay. So now, what is I have sent to all of you? You can download. What is your event? Your event is 23rd March 2020, right? So this is your event day. Yes or no? This is your event day. Yes?
Yes, sir.
Yeah. Now you need to first decide what is your estimation window. How many days you want to measure the impact.
So we could take a week window also. 7 plus 7 minus 7 would be uh, appropriate to know the result, immediate impact of the.
Week, see, in market week is 5 days only. See, it's not 7 days. If you are seeing 1 week impact, you will see the 5 days impact,
Okay, sir.
because 5 days trading is allowed. Okay. So suppose you are taking 5 days, we will go by your suggestion, plus minus 5 days. First you go, so you can mark it. This is, you can mark the event into different color. This is sorry, this is minus 5 days, and you go for plus 5 days. Plus 5 days. So your event window has been decided. Yes or no? This is your event date, before 5 days, after 5 days. All of you have decided? Yes or no?
Yes, sir.
Yeah.
Yes, sir.
Now what is the next step? We have to decide our estimation window. Okay. So estimation window is coming as 298, 297. We can go for 298, not no harm, but go for 240 or 250. If you go for 240, 250, before the event window, whenever event window ends, before that 240 days you go for. Suppose here is 240, you can just insert one. You can also remove this all the above data, or you can simply take this data into a different part. You can take into a different columns. So whatever data we have got, we'll be placing here. Now you calculate the return. So you just say equals to ln. One day you will miss. So equals to ln today divided by yesterday, then multiplied by 100. You get the natural log return for both Nifty and Reliance. Okay. Now you got whole of the return series for the Nifty and Reliance. Now you got your event window as well and estimation window as well. Now this is your event window return and event date. I hope all of you have reached to this level where you are able to calculate the returns and able to figure it out what is your event window. Yes or no? All of you have done so far?
Yes, so I'm just a little confused that why we had to take it into a different column. We can just leave it in the same column.
Same column also we can leave it, not a problem. Only we have to give one one break there. So wherever it is, it's not a, as for our comfortability only we have brought out two separate column. Now you give two breaks. One break is over here, Okay, because after this you are not bothered about now, because your event window is 5 only. Okay, plus 5 to minus 5. If you are measuring plus 10 to minus 10, then you will go for measuring this. Now here you give another break, just insert one blank row. Now your estimation window and event window has been separated by one blank row. Inserting one blank row. Here inserting one blank row. Okay, done. You can write down
Yes,
this.
yes, sir. Just hold on, sir.
Yeah, the first one is RM, then second one is RI or Reliance return or securities return. Yes. Once all of you are done with this, just tell me, then we'll proceed further. Ali, you are doing? Binoy?
So you have given a break between 13th and 16th and between 30th and 31st, right?
Yeah.
All right.
So you want to calculate car and everything here.
Yeah,
Okay.
yeah. That's why you have given one break. So this will be separated. You can give one more, or you don't write here. You just copy this return, paste it without formula. Paste it as values here. Copy this return of event window, market return, and your Reliance return, and paste it over here without formula. Just paste it as values. Done. Once you are done, just tell me. I'll proceed further. Shall we proceed?
Yes, sir.
Yeah. Now, what is the next step? Can anyone say what is next step?
Maybe find the betas in all three different segments.
Yes. So we want alpha and beta. That means we want to apply market model here. We'll say Ri equals to alpha plus beta Rm. You regress Rm is dependent, independent variable, and Ri as dependent variable. Do one regression. Now we have that regression will be done in which window? This regression will be done in estimation window. Okay, estimation window. Now come back. Nifty is independent variable, Reliance is dependent variable. Go to data analysis, go to regression. Say okay. Now what is your Y? What is Y here? Can anyone say?
Reliance values, sir.
Reliance value. Y is your dependent variable. So you select Y, then come to X, select X, then say labels. Labels means names are there in the first row. Then you can simply say okay. Okay. Once you say okay, your regression will be run. You are coming out with your alpha beta value and standard error. All of you got this regression result? All of you got? Or should we repeat?
No, sir, my values are different from yours, sir.
Your window is different?
Sir, I believe I have the same windows as you. I'm getting slightly different values for the alpha and beta.
No, how can you will get different? How you have computed the return? Have you
So,
used this ln, the same formula that I have used?
yes, sir. So I've used ln, and then for the first row it's blank, sir. For the second row, it is third over second return, ln bracket open b3 divided by b2 bracket close multiplied by 100.
Okay, so um, you have not used this main formula, so there is slight difference on the return. Almost same return you will get. So slight difference. That's why your coefficients are different.
What have you used? I'm so sorry.
It's ln pt divided by pt minus 1 multiplied by 100.
Yes, sir. Same thing, sir. I have
Then,
used ln. I have used ln b3 divided by b2 times 100.
then that is correct only. You have left one row blank, or you have
Yes, sir.
named here.
The first one comes out as blank.
So you have to remove that blank.
Yes, sir. Remove the blank, sir.
And see how many observations you have. Say 239 observations you have. Number of observation in the estimation window.
Okay, sir. I have more. I have 296. I think I'm starting.
That is what. That is what.
Yes, sir. I think I'm starting earlier.
Not a problem. Okay, you have considered whole the period. Not a problem. Also, you can do that. That is what you are getting different alpha beta values. Okay. So now we got this alpha beta values. Copy this alpha beta values, and we got on standard error. This standard error will be required for calculating the t-test. Okay, you copy this all to and come out to near to event window and paste it. This is our bread and butter for going further towards the event analysis or event study. So what is next step? Can anyone say?
There are either two ways of doing this. Either you try to get the beta for event window, alpha beta, or you can try and put these values into that model and see what is the standard error you're getting.
Yeah. So you are asking about standard error only.
I'm so sorry. What I meant was, you either put these RM and RI values and try to find your MSE values, mean square errors, or the other thing we can do is we can try and find the alpha beta values for this part of the model, and we can try to see using t-test if our alpha and beta are similar to each other or not for the two values.
Yeah. So the next step is we want this using this alpha beta value. We want expected return. We want to calculate the expected return of this event window. How we will do this expected return? Again, Ri equals to alpha plus beta Rm. Okay, alpha plus beta Rm. Now you use this alpha and beta value from here. This intercept is nothing but alpha. This nifty coefficient is nothing but beta. Okay. You do equals to, you say alpha plus beta multiplied by Rm of event window. Event windows Rm. Now this alpha and beta value will be same for all. Just fix it by function f4, because alpha beta value for same for all days. Okay, so you are getting expected return. Now you come out, this was your event day, this is your 0 day, write down 0, and before that it was say -1, -2, -3, -4, -5. This is +1, 2, 3, 4, 5. Okay. Now we got the event. Event window has been decided, -5 to +5. Now you are getting this expected return. Expected return is nothing but alpha plus beta multiplied by market return. All of you got it? Yes or no?
Yes, sir.
Just do for all. Just you can double click or scroll. You are getting expected return for each days. You can mark this event day in different color. Then you come out with abnormal return. What is abnormal return? Equals to actual return minus expected return. You have expected to get 99 marks. If you are getting 98 marks, then you are getting -1 marks from your expectation. If you have expected 90 marks, you are getting 95 marks, then you are getting 4 marks higher than your expectation. So we calculate abnormal return equals to actual return, that is RI, actual return of Reliance, minus expected return of Reliance. So every day you will get some abnormal return, either positive or negative, your actual and expected. All of you are getting this. This is nothing called AR. You are getting AR.
So shouldn't we square it or take some mod of it?
No, it is simply actual minus abnormal. Sorry, actual minus expected. You don't take any mode or square it. Okay. All of you got this?
Yes, sir.
How many of you got so far? Can you raise your hand? Only Neil or others are Himanshi? Yes, anyone? Rajaditya, Chari, Srivadhini, Kirti, Sarvesh, Gaurav, Srivadhini, Binay. Okay, what about others? If you will get this in your periodicals, what you will do? Just on a lighter mode, I am saying. Okay. Now, what you do? You get this. We got the car AR. Then you get the CAR. That is cumulative abnormal return. So this becomes our AR. So AR equals to actual return minus ER, expected return. Okay. Now CAR, you just cumulate it, equals to this. This is cumulative equals to this plus This one second day, so this will be cumulate. Now you just scroll it. Every day you are accumulating, and total cumulative return is available with you. All of you got up to this AR and CAR. Yes or no?
So I was a little confused about CAR. What did you do for CAR?
Just cumulate this plus this, whatever will come. So
All right, sir.
then you do this plus this.
All right, sir.
Whatever comes this plus this. So if you do set one formula, previous from CAR plus same day AR, you will come out with this. Okay, done. Done. Now t-test for AR, t-test for CAR. What is the t-test formula? AR divided by standard error, here CAR divided by standard error. Okay. All of you are following me? Yes or no? Sarvesh, Cherry. Today Saranya is not there? Okay. Ollie?
Yes, sir, we are following.
Yeah. Ollie? Ollie left or what?
Sir, I think he was having mic issues even then when he had asked us.
Okay.
Sir, he has just responded.
Okay. Okay. So now what you do, you say equals to AR is this divided by your standard error. So just freeze that standard error because standard error is same for all. So you will get t-test for R. Then you come out with t-test for car equals to CAR divided by again standard error. Freeze that standard error.
So just a doubt. There are two standard errors from the regression. Which one should we use?
Use the model standard error. This one, not this standard.
All right, sir.
For model standard error. Okay. So now you got the t-test for car. Okay. So we have done so much R car expected return, but what is the conclusion now? Can anyone conclude this?
So lower the t-test values, the better it is for us.
Why?
Sir, because we are first finding the sir, these AR values, abnormal returns, is how much you're deviating from your normal value. Now the thing is your t-test. So we found a standard error of the model. So that gives us a benchmark amount we're allowed to miss.
Sir,
Right.
I think Neil is trying to say opposite of it. The larger the p-value, larger then we can reject the null hypothesis, that is that variable is not significant. So the larger the t-value, the better is the.
Larger the t-value, better is the result in terms of significance. So if it is
Yes, sir.
If it is larger, then it is significantly impacting. That particular event is significantly impacting. Now do one small thing. Just insert one column here. Copy this day -5 to +5 over here. Try to plot this AR and car. Okay, in many of the research paper, in many of the RBI working paper also, you will see this event study is widely used, and they represent this R and car plot. Just plot it, R and car, but while plotting, you should be carefully mention this day with 0, -5, +5. Okay, so plot this AR and car. So plot this AR and car. Now this 0 is your event day. After event day, it is impacted. The R has impacted or not impacted. The countrywide lockdown is positively impacted or negatively impacted to Reliance share or Reliance abnormal return. Are you able to see this figure? The blue one is AR and the orange one is CAR. Okay. Now 0, this is -5. The next one is +5 event day. Can anyone interpret this? After event, what happened to R of Reliance, car of Reliance? Anyone? Any one of you? I hope I am audible to all of you.
So for me, on the day of the event, there's a big spike.
Yes,
In
spike, upside, downside.
upside, sir.
Yeah.
And in my diagram, sir, because I think I've taken a different
Yes.
number of
Yes.
And then there's a downward spike over the next 2 days. Meanwhile, the car on the -5 and +5 is very similar to AR, but on the central days there's a slight deviation. This is what I'm seeing in my diagram.
Yeah, the similar diagram you are getting, what I also got. So on 2 days, prices has gone up. Just see, when other companies, this is a negative news. When other companies' prices has came down, this prices has gone up. That means the abnormal return of Reliance has gone up. That means Reliance was up whenever negative news also was there. There are certain reason behind that. But after second day, it is sharply fallen down. But from on to third day, from fourth day onwards, it has started rising up. And cumulative abnormal return will accumulate all the holding period returns. That's how it is falling, but it's in positive region, and it has been rising. So what we can conclude from this graph is this particular event of countrywide lockdown has resulted positive abnormal return for 2 days for Reliance. After that, 2 more days, that means 2 to 4 days, it was down, and from fourth day onwards, it has started going up. Whether this impact for 2 days positive, next 2 days negative, and further it was going up was significant or not significant, we can test through this R and car. What is the minimum value of significance for R and car? T-test, the minimum value is 1.67. So if we are getting 1.6759, that means it is 10% level of significance. If you are getting 2.0086, then it is significant at 5%. If we are getting 2.6778, then it is significant at 1%. Now, if we are getting minimum of 1.67, then we can say it is significant. These three are significant. These two are significant. Yes or no? So
No,
before,
sir.
yes.
At 0, it is not significant.
So at 0, it is not significant. Yes, that is true. At 0, it is not significant. But this value of t-test is respective of any of the sign, either positive or negative. Because when we take paired t-test, it takes both the sides of the distribution. Now you say it has impacted positively and significantly on the next 2 days and next 3 days. Yes or no? The AR has impacted significantly, and car has impacted here significantly. Car has significantly impacted in most of the days. So you are coming to an conclusion, yes, this impact is there. Now you are coming to an conclusion whether this impact was significant or not. Yes, on the post 3 days it was significant, pre 2 days it was significant. So you can conclude by this saying the countrywide lockdown has resulted positive AR by how much? AR positive of abnormal return in the event day was 1.31%, but in the next day it was 3.76%. Second day 6.63%. 6.63% abnormal return is too high. Then suddenly it has came down by 5% down and 0.28 down, then up by 1.61. Now this is indicating we should check 10 days window also. What is happening further? Yes or no? We should check 10 days windows plus minus 10. What is happening further? Okay. So now anyone can do event study. So I am sending this file to all of you. Those who are not able to do, you can do this. So in your result, if you are writing any paper or writing any short article, you can place this table AR, CAR, t-test of our car plus this day plus this plot. Okay. Now, if I want to test all the Nifty 50 companies impact of this countrywide lockdown on all the Nifty 50 companies, how do I do? How do I do?
So could you repeat your question?
I want to measure the impact of this event on all the Nifty 50 companies.
So we can take the sector indice.
Sector, I want all sectoral indices. You are saying, okay?
Yes,
That is
sectoral
also
indices.
there are many paper they also consider that, but what you can do is you calculate the AR of all the companies, AR of Reliance, AR of SBI, AR of Dr. Reddy. You calculate all the 50, then you take the average AR, that is called average abnormal return, average AAR, that is called. Now you calculate cumulative average AR. The standard error also you can take average, then you can come out with AAR that represents whole of the 50 companies or 100 companies or 1000 companies. There are papers they have studied dividend announcement, stock splits on 1000 companies also. So you can come out with a single table. You will not come out with 50 tables. In your report, you will place single table, but that will be AAR. Clear? Yes or no?
Yes, sir.
So you're saying that we'll be calculating AR for different companies and then we'll be combining them together to calculate CAR and then we'll compare it with the Nifty.
No, we combine them to calculate the AAR first. We
Okay,
just
average abnormal return.
average them to get the average abnormal return. Then you calculate CAAR. So cumulative of this average abnormal return. Are you getting, Rahul?
Yes, sir.
Yeah. So I'll just send this data file to all of you.
Sir, essentially, event study is used only to test efficient market hypothesis, right?
Uh, See, efficient market hypothesis plus whether it has impacted or not impacted.
So if it is persistent in the market, like, there are abnormal returns existing, which means that people are not rational enough to analyze the situation, right?
Yeah, yeah.
So once it is like, the correction measures kick in, so we are essentially saying that the market have corrected itself. So now EMH holds. So would it be the right way to interpret the results of this particular event study? That if we do not observe any abnormal return, we say that efficient market hypothesis holds in the market.
Yes.
So
Yes.
that is the way we can present our results, right?
Yes.
Okay, sir.
Okay. So those who have not got, you can see this example file. So with this, we can close today. Just for attendance, wait. So 2 more days we have missed. I have that attendance. What was our first class date? Anyone has reported? First class and second class date? Anyone has noted?
21st and 23rd August.
21st. Then 23rd.
Yes, sir.
Then after this 13, we had 2 more sessions, right? Yes, 11th and 18th. This was 11th and 18th. This is 13, 11. One more was 18th. So how many classes we have done till now? Anyone can tell?
So 8 classes including today.
8 classes. Yes, 8 classes. Okay. Who are present? Just quickly tell. Or should I call one by one? Okay. Akash, Anchal,
Present, sir.
Ayush, Adhyasa, Tejas, Olli, Anjali, Anmol, Parismita, Abhani, Ayushi, Sarvesh,
Present, sir.
Bhavya, Teddy,
Present, sir.
Diksha, Diksha is absent. Dipans, Gaurav, Gaurav is absent.
So present.
Gaurav, Santosh, Himanshi,
Present, sir.
Jaideep, ARUC,
Present, sir.
Krishnakant, Kirti,
Present, sir.
Mansi, Mansim. Oh, what is your name? Mansimran. Mansimran, Manvi, Mihir, Muskan,
Present, sir.
Namrata, Neil,
Present, sir.
Nikhil, Prasun, Pratik, Rachit,
Present, sir.
Rahul, Rahul Ghosh, Rahul Giri,
Present, sir.
Rahul Goswami, Radyaditya,
Present, sir.
Rasi,
Present, sir.
Rishav, Roma,
Present, sir.
Sahaj, Samiksha, Saranya. Saranya was present always. Today she is absent. Subham,
Present, sir.
Subham Kumar, Someswaran, sorry, Someswar, Stuti,
Present, sir.
Stuti, uh, Sanika,
Present, sir.
Vinay,
So it's Vinaya. Yes, I'm present.
okay, Vinaya. Okay, thank you all.
Sir,
Yeah.
so what assignment, like what can we expect in the assignment?
Today I'll send to all of you.
Would it
Assignment will be on this return and portfolio. So it's a it will be given to all of you. Now that how many days you will take for this assignment?
So please get enough time because every day we have some other placement talk or placement
So
interview.
next week you have classes or you don't have?
During
Yes, sir.
periodical, we don't have classes.
During?
During the test time, we don't have classes.
Okay. So enough time means how many years you want?
Sir, 16th September, post 16th. Like if you can take it till 16th September.
16th
16th
September?
October.
Oh, sorry, October.
No,
My
that is too much here. Your exam department will ask us to give marks. So how we will give?
The 10th
So
October.
it also depends on the assignment.